So good morning, everyone. Good morning in Europe. Good afternoon in Asia. Uh, Very much welcome to this World of Open Account webinar. Very pleased with this one. We do many webinars, many web meetings. I must say I'm especially excited about this one because it's almost the reason why World of Open Account was launched now 2 years ago. We really wanted to have a community that shared thoughts, that came up with new initiatives. And this is really an initiative from the community, from people who said, well, we are trying to do something new. We're trying to revisit, reinvent almost a model for cross-border factoring. And I think there is some interesting meat on that bone. And the purpose of today is, of course, to share knowledge and to share this idea with the broader community. But then most of all, at the end, we hope that we will be able to have more enthusiasm and people who want to join this initiative in a working group and to see how we can broaden this new model. So let me start by introducing you to the panel. We have very good panelists today. We have Pramit Joshi, who is co-founder of NewFi Credit in Singapore. We have Torsten Klintwort, CEO of ABS Global Factoring in Germany, and his colleague Lea Wernersbach. Frank Guan from China, who is also working with World of Open Account on our Chinese chapter. We have Christian Faber, partner at Bette Westenberger Brink law firm in Germany. And last but not least, Louis Hofmeier, who is special advisor Impact Kenya, but he's much more than that. He's very experienced person in this whole industry of receivables finance. So the agenda for today is consists of 4 parts. We have a problem setting. We will talk you about what's going on. It's again about the gap, the famous trade finance gap also for SMEs between emerging markets and developed markets. And then we'll talk about this new approach, this new idea, new model, not only in theory, but also in a business case, because it works already. And that's also important to know. This is not something that is just being popped up in the air as an idea. It's very much also already working and being checked, as you will see also from legal and operational aspects. And then we will, of course, have Q&A. By the way, concerning Q&A, don't feel afraid. Don't be afraid to ask your questions even during the session. You have a Q&A button somewhere on your screen. It depends on how your screen is set below or above. But if you click on the Q&A, you can launch a question and we will monitor those, and we will either handle these right through the webinar or certainly at the end when we have a Q&A session. So that's enough for me. I'm going to hand over with the problem setting to our first panelist, to Pramit Joshi, who will give us his view from India, from Southeast Asia, and a broader area. Pramit, over to you.
Thank you so much, Eric. Very happy and glad to be on this panel and share our experience about the trade. And I'll quickly take you all through the problem as we see on the ground here in India, Southeast Asia. The idea is, what is it that we are facing and how we can go about to solve this a lot better than the existing options that are available. So just I'll request audience to focus on the right half of the slide where we are talking about the outbound trade that happens from India and Southeast Asia to developed world, which is largely European Union, UK, US, and some of the other countries in that part with much better per capita incomes, and the underlying goods that go out consist of basic value adds which happen here, and primary reason there is ample availability of labor at much more cost effective price points, and also adequate raw material availability, because of which there is a booming and a very large MSME segment which manufactures and is eager to export to the developed countries, but there are a lot of challenges to scale this up. Governments across have been promoting for decades how to increase these export volumes, and financing is clearly a bottleneck. So the nature of industries, what we talk about turnover wise, we are largely looking at manufacturers, SME manufacturers, small and medium sized businesses, which are less than about 100 million US dollar equivalent in turnover. They do minimal value adds. It's not very tech savvy or value adding, but it is conversion industries which work here and want to export to the developed countries. And the incentive clearly here is the differential interest rates and inflation lead to much better payouts because of regular depreciation of the local currency, and selling to better jurisdictions give them a lot more payment clarity and better margins, which leads them to a better growth compared to vis-a-vis they selling into the domestic market. And clearly every SME manufacturer that we have been meeting for more than a decade, hundreds of them have only one objective, is to how to increase their exports to the developed countries. So that's the opportunity part of it. And the way you see the mix, 50% share of these exports is by these MSMEs, whereas the penetration of cross-border factoring, the traditional solution that we have, is less than 1% across India and some of the other comparable economies like Indonesia, Bangladesh. We have seen this across, that it is not available. The local banks and non-banks are regulatorily bound, number one, and even in terms of the risk appetite and opportunity, they are not willing to offer cross-border factoring or financing without recourse to the SME balance sheet as a readily available option. It is clearly against their unit economics, given the Basel regulations, especially after 2008. The kind of capital provisioning that it takes for these SMEs to be funded by banks is simply skewed. These are unrated assets for them, which requires 200% capital provisioning, and they don't want to take on this. And especially given the coordination that it takes for such cross-border factoring transactions in the old way. Number one. Number two, the operational intensiveness. If you do the same amount of paperwork that you do for the conventional transactions, doesn't fit in. And as a result, the outcome here is about 50% or more of the working capital finance requirements for exports of these SMEs is unmet. And that's where we are trying to carve out a solution. How can we do this better? And opportunity wise, we are talking about a very, very attractive yield differential to be captured, because the funding that is available to the SMEs here is near double digit in terms of interest rates, whereas the availability in the borrowing markets or buyer markets we are talking about is extremely cost effective, and that spread is something that can be distributed across financial intermediaries, and still we can make a very good business case out of this. One clear roadblock that is out of the way, and COVID or the pandemic has clearly been a catalyst, is digitization, right? Even the smallest of the SMEs that we talk to here are now completely open to digitizing the way they do their business, the way they interact with financiers, banks. Everything is something that is getting digitized, and that's exactly where we are trying to digitize the first mile of the cross-border leg here, and then from there on we can go and completely end-to-end deliver an asset class which is digitized, much better risk profile, because the shipments etc have already happened and we are shifting out to the buyer side here. And that's exactly where we think there is a huge gap and a large opportunity that can be filled in. And if you look at numbers also, in terms of sheer number of SMEs is more than 1 million in India alone. If I add Indonesia, Thailand, that number is going to go to more than 2x. And if you look at the banking assets itself, India alone has 1 trillion US dollar equivalent of bank assets, and the cross-border factoring contribution again is less than half a percentage here when we are talking about. And that shift is clearly underway. The idea of today's forum is more about how can we accelerate this shift. Thanks so much, Eric. I'm done on my comments here.
Okay. Thank you very much, Pramit. I think this is a very clear picture you have shown about the issue, about 50% of working capital finance that is not met, and at the same time, the huge opportunity that exists. So very good introduction. Thank you very much. Let's go and see and hear from Frank. And Frank, if you can share your thoughts on the same issue, what's the problem, but from a view of People's Republic of China.
Hi, Eric and everybody. Good morning and good afternoon. I'm very glad to share something about the market in China. And in China, in 2020, the total export volume in China is about 2.7 trillion US dollars, and the total import volume is about 2.18 trillion US dollars. So this is a very, very good, very big figure and a very, very big market. As per the survey sponsored by the China Commercial Factoring Expertise Committee, more than 70% of the export are being with the credit payment terms, such as the DA document against acceptance open account, and the 90% of the SMEs have a very, very clear demand for the cross-border trade financing against the open account payment terms. Meanwhile, as per our survey, we found that for the exporter and the importer in China, they get more and more familiar and more better understanding with the factoring, reverse factoring, credit insurance, besides the letter of credit and the forfeiting. So, okay, so to date, banks are still the leading role in this area of cross-border trade financing due to their foundation and network facilities. And relatively, I think that the financing provided by banks I mean the rate is relatively very low. And however, it is quite clear that in this area, there are two major challenging points in front of the market. The first one is that most of the cross-border trade financing provided by the banks are based on the seller's credit, not the buyer's credit, not the trade credit. Especially for the SMEs, normally they need to provide the collateral or even the guarantee in order to get the financing. So the current environment is not a very convenient or maybe comfortable to the SMEs. And another challenging point is that for the financial institutions in China, they have to solve the problem of the information asymmetry in order to have a better management on the risk. Otherwise, they could only provide the service based on the seller's credit. Okay. And also, in the last 10 years, more and more non-bank financial institutions in China have participated in this market and become proactive in this market. Their product and the service are more flexible and more comfortable to the market. And at the same time, with the development of the technology, including the big data, artificial intelligence, blockchain, we can see a big opportunity for the innovative cross-border trade financing. And the trend for digitalization is more and more clear. So I think that the market in China is to somehow quite similar to other market, and we look forward innovative structure and business model, especially in the area of international factoring business. So we do look forward to it. Okay. Eric, thanks.
Thank you very much, Frank, for your analysis, which indeed is very much in line with Pramit's comments, which is, well, good to hear that great minds think alike. So the problem seems to be very much similar. Let's have a look at other parts of the world, view from Africa, and maybe other parts, because Louis, as I said at the beginning, your experience goes beyond Africa, but you are very much involved there for the moment. Can you share with us your thoughts about what is going on in terms of limitations and issues for export financing, cross-border factoring, if you want?
Yes, thank you. Of course, we support this initiative very much. At this moment, I work for Impact, which is maybe not well known, but it's a subsidiary of a large non-bank financial institution, Cardano Group, which in itself is cooperating with commercial parties and development banks through blended funding, blended finance. And these parties have decided that they want to set up even a network of factoring companies in Africa, based, as I said, on blended funding. That's important. Why? This will be in Kenya, but also in Zambia, in a lot of parts of Africa. And these factoring companies are traditional factoring companies in a way. I think that and why are we doing that? I just want to give you a short overview of the situation in Africa from my point of view. As you probably know, there is not much factoring in Africa at the moment. Of course, 80% of the continent's turnover comes from South Africa. That's a large market with over 100 factoring companies. And of course, in the north, we have Morocco and some other countries like Algeria, Egypt. But basically, the penetration of factoring and also export factoring is very low in Africa. And it is, in a way, the last frontier of factoring. Why does it not work? And still, of course, as you know, all of us know that SMEs need this kind of finance. It's the blend between protection of the collateral, the service, and the other financial funding options. But why is it not has it not materialized in Africa? And I think that it has to do with the product set that so far has been introduced by other development initiatives in Africa. And the thought was that they could leapfrog the factoring industry by immediately introducing, for instance, rather complex products like supply chain finance. And on the other hand, simple products like invoice discounting, which is very incidental nature and not very much used for cross-border factoring. Supply chain finance in itself is of course a good product, but it is based on anchor buyers, and these anchor buyers impose their payment conditions on their suppliers or often the small SMEs. So in a way, and this product is now being offered by banks, but in a way that doesn't always suit the balance of power in the supply chain, and that plays an important role in Africa. The dominant buyer or the anchor buyer has a lot of power. That is why we think that the shift towards supplier-led programs, so in a way that's traditional factoring, but of course in a new code, is extremely important. And that is what my group wants to achieve, and to give the power or the power in supply chain back to the sellers. And this initiative, which is about export factoring, really suits well this initiative of empowering the sellers. So we are very much in favor.
Thank you very much, Louis. And of course, we can get back afterwards during Q&A session as well, and then hear from you. But, in a certain way, you have indeed already mentioned giving power back to the sellers, and I think this is what the solution is, or the model is very much about. It's a blend, or it's a hybrid form between seller-centric cross-border factoring and some features of risk mitigation in terms of supply chain or reverse factoring. But I'm not going to talk about that because we have people who know much more than I do about this model. And so I'm going to hand over, when we talk about this new approach, to reveal how this works and how this should work. I'm going to hand over to Torsten at ABS. Torsten?
Yes, thank you, Eric, and good morning to Asia. Good afternoon to Europe. So yeah, I'm telling you a little bit more about the European perspective as we have registered it. What we have seen in the past, let's say 5 to 6 years, was that we received lots of inquiries from, especially from the Asian area, to support Asian fintech companies, Asian receivable finance platforms, or also traditional factoring companies, to support them in regard of the export to Europe. And that was very interesting because the number of inquiries really grew in the past years. But of course, there were also some, let's say, inquiries that we did not take too serious because the underlying model was not appropriate to set up a financing structure for them. Nevertheless, we started looking into the actual situation. So, what are the limitations that Asian export financing platforms or fintechs or factoring companies are actually facing at the moment? And if we look at the next slide, we found out that there's basically, let's say, four issues that a lot of Asian companies are struggling with, which is first of all the quite expensive and the expensive and complex networks that you need in order to establish the cross-border supply chain finance. So everything what exists at the moment basically comes from the old world before the digitalization and before the new trends that we have been facing, especially since the financial crisis in 2008 and 2009. I mean, there is instruments how you can finance supply chain finance, especially in the cross-border situation from Asia to Europe. But as I said, most of the models are quite complex and are also quite expensive. And that already leads over to the next point, which is
sorry. Okay, sorry.
I still wanted to explain a little bit about the old-fashioned way. So still we see a lack of digitalization because all the old instruments are from the old times, were invented before the digitalization. So there's a lot of paperwork still involved. Of course, this is not really a modern way of doing it. At the same time, the processes are quite complex, they're quite time consuming. They take quite a bit of time. And this, of course, is also a little bit problematic because if you have payment terms of, I don't know, 30, 60, 90 days, and it takes you already 2 weeks to set up a cross-border financing, then of course you would lose a lot of time already. And then last but not least, we also found out that there's still a lack of acceptance by the European buyers, especially by the smaller ones. And this is what we have seen in the past 10 years with all the modernization in the whole world, with the globalization. More and more European buyers are not the big brands that you know all over the world. More and more European buyers are companies out of the typical SME area. So even companies with a volume of only a few million euros or dollars turnover a year start buying their goods directly from Asia, from India, from China, from other countries in Asia. And this is a very strong development in our eyes. There's a shift going on between the old traditional big importers in Europe who of course have all the instruments on hand that they would need to finance the cross-border business. But the shift is ongoing to more SME companies in Europe. And these were the, let's say, the issues that we found out in our research. And that was kind of the, let's say, matching European perspective to what Pramit and Frank just explained from the Asian perspective. So what we did, and maybe we can go over to the next slide. We've got in touch with NuFi, with Pramit, and we've been looking at possible solutions. What can we do in order to establish a new way of cross-border financing? And a few years ago, we introduced our new digital supply chain finance product, which is called QuickPaid, which is basically a reverse factoring product from the perspective of the buyer. So the buyer, the debtor, is the one who is the active part at this product, who is demanding the product and is using the product. And this product we call QuickPaid was a very new digital product. And we looked at it if there is a way to adopt the product in a way that it can cover the cross-border financing in the way it was needed. And that was the setup, that was the project. And together with NuFi, we developed this new way of international trade platform. And here you can see how it basically works. Still probably not rocket science, but on the other hand, it's a very streamlined product for the needs that we faced in the Asian European cross-border business. So as you can see here, together with NuFi, we formed an international trade platform, and this is basically the core of the whole new product. It's a cross-border trade platform, but it has two sides. So there is the Asian side and there is the European side. So at the Asian side, the Asian exporter would submit the export factoring to the export invoice to the platform, and then internally, in this case, NuFi would hand over this receivable to us, to Europe, and then we would get into touch with the European buyer and ask for a confirmation. And as soon as we have the confirmation, then we would cover the invoice and we would finance the invoice. We would transfer the funds to Asia. And of course, on the Asian side, you also have, let's say, a traditional factoring solution with the risk coverage and with the financing. It's quite simple. It's very digital. It's very fast. Of course, we need to know the European buyers. We need to check them. We need the credit coverage for them. That is a very crucial part of the whole project. And then on the other hand, what we also need is the debtor confirmation. So the buyer, the European buyer, would basically check the goods, would basically check the shipment and the invoice, of course, and then submit a confirmation to us. Yeah, maybe at this point I hand over to Chris.
Sorry.
Yeah.
Yeah, sorry, I was, you want to go to the next slide or, sorry, no.
Yeah, I think if we want to go a little bit more into details, especially to the legal level.
Yes, of course. I just wanted to, I was writing down because in a nutshell, Torsten, you can say that the model is very similar to traditional two-factor cross-border business with two enormous differences. First, the import factor, if I can call you that way, in Europe is contacting the buyer to obtain confirmation. So that's the part of the supply chain reverse factoring approach. And at the same time, it's of course even more important, it will be the European import factor who is going to finance also the receivables. So at the costs, of course, of European financing. And that's the two big changes. And on top of that, of course, the whole layer of digitization, which makes it easy, but that's going to be discussed now during the more operational aspect. All right.
Yes, that's correct. And also maybe if I may add that what Luis just pointed out before, that the whole system puts the seller in a more powerful role again. So we are really getting a little bit more independent from the seller and from the seller's creditworthiness, because in the end, the crucial point is that the buyer accepts the invoice, accepts the shipment, which you usually have in a cross-border business relationship, because you have defined shipments. They are usually monitored all the time. There's a proper documentation in place. And usually there's also a very high interest from the European buyer side to get the goods at the agreed pricing. And of course, then you also has an interest to make or to enable the business trade at the Asian price level, and also to obtain payment terms for himself, so that he might gain 60 or 90 days or whatever he wants to, in order to have his working capital in order as well.
So I think that Christian will probably add some of his comments here at this point, Torsten. That's correct?
Yes, correct. I think we should go over to the legal and operational level, and then I would hand over to Christian.
Yes, thank you, Torsten, and thank you, Eric, for the remarks you made. I just would like to introduce myself, Christian Faber. I worked on this product as a lawyer regarding the product development here. And I know that the marks of the lawyer aren't probably the most interesting ones in such webinars here. So I try to reduce it to a few cornerstones to give you a better understanding of the product in a legal perspective here. As Torsten and Eric pointed out, we established a platform here, which is not the innovation at all. You do know international factoring platforms already. As Eric pointed out, a new approach here is that the European factor is the one addressing the debtor, asking and checking the debtor, asking for some confirmation. I'll explain that later on. And the European factor, and that's the main difference here, I guess, in the structure, is the one providing the finance, providing actual funding. The task we had is the one that Torsten pointed out. The task was to develop a slim product, a streamlined product here, working fully digital. What we did is to establish a platform which could be used by everyone who is participating in this webinar, actually, because you do not need any supranational organization. You do not need any special technology. All you need is to step in a legal structure which is provided by templates, and use that legal structure by connecting your IT systems to use it for the receivables you would like to trade. So the platform we are talking about here is a combination of the two players who established that here. QuickPaid from ABS Global Factoring on one hand, NuFi Credit on the other hand. So a European and an Asian player working together, running that platform, which is made up from a legal structure, a legal documentation, which is provided here for everybody participating in that. We do have two assignments of receivables. You know that from different two factoring systems. You have an assignment of the receivable within the Asian market and another assignment between the two partners here. So the Asian exporting factor is assigning the receivable to the European importing partner here. The main difference to other factoring systems beside providing funding is that the European factor relies on the debtor. The European factor does not step in any risk here. Looking at the situation in Asia, at the situation between the supplier, between the Asian factor, but relying on the debtor. I pointed out a few cornerstones at the bottom of the slide here. Let's just go through that to give you a better understanding here. We start at the right-hand side. So the Asian factor in this system, in this case NuFi, is reliable of fraud prevention in its own interest. In this case, NuFi won't accept, won't buy any receivable which doesn't exist, which is sold by the wrong person, so carrying out a KYC process and so on. The Asian partner is also reliable of disclosure of the assignment here. There are many opportunities to carry that out in special. We won't dig in deeper here, just to give you the part or the idea which opportunity you can take to structure this here. Most important in international factoring communities, in collaborations like this one here, is the governing law and the enforceability of the receivable. This is the actually to tell you from my perspective as a lawyer for many years in that industry, this is the biggest hazard in international factoring. The governing law and the differences of law and the conflicts of law, and due to that, the lack of enforceability of a receivable. So we found a solution on that. We do not work with some retainers or escrows here that would raise the complexity of that product a lot. So we waived that. We also do not need any instant payments here or any stages. We do not need to rely on assignment bans, on set of rights, and so on, because we do get, as on the European side, and we finally arrive here on the left-hand side, a hard confirmation of the debtor. So the European partner here, ABS Global Factoring, or the QuickPaid system, carries out a credit process to rate the European buyer and rely on that one providing finance. This is actually these are the most important cornerstones on a legal point of view. We are very open, I guess, Eric, to discuss that afterwards, or bilateral if there are more questions about that system. But I think on the legal way, this should be sufficient here to focus on the more commercial and the more innovative part of it. Maybe one mark we don't have on the page here. We are working with digital signings in all stages of what you see on these slides. So no paperwork and high reliability on the identity of the partners here.
Thank you very much, Christian. And indeed, we do not have time today to dive really into all the details, but I think personally this gives a good overview. And most importantly, I would say this has been thought through. This is not just, as I said at the beginning of this webinar, this is not just a wild idea. It has been thought through, it has been tested. And an important aspect, of course, also is that, and that's also the reason why we do this webinar, it's not just to say, well, there are two partners, NuFi and ABS, who work like this together, but it is, of course, perfectly possible now to add additional what I would call export factors and import factors, whatever you call it, financiers on the side of the suppliers and financiers on the side of the buyers to this platform. We can add, of course, additional players, and that's the whole purpose.
Yes. Yes. Maybe. Sorry, Eric, to interrupt. Yes, I might have left that out. The legal structure is made to scale it up, even for a lot more partners. We have engineered a lot there. We killed all the bugs in the product at the beginning. It's now more than a proof of concept. It's actually running, and it's ready to be scaled up. Yes.
Okay. Thank you very much. So, and talking about reality, that's what we said as well. The idea was, or is definitely also to show you that it has been working, it is working. And so I would ask Pramit to quickly give an overview of a business case. Pramit, can I hand over to you?
Sure. Thanks so much, Eric. Just quick check. How are we doing on time? How much time do I have to cover this?
I think we're doing well. If you do this business case in 5-10 minutes, we have still time for questions and answers. So that's perfect. No problem.
Thanks so much. Just, one, recall that we have while in hindsight, the structure that we see looks out to be pretty neat. The way, we toiled actually to remove the bugs, as Christian mentioned, to arrive at a seamless solution which can be acceptable to the European buyers and also seamlessly for the sellers out of Asia. They did take a lot of iterations around it, and we really want to now scale this up much faster to a much larger solution for the problem that we saw initially. I'll just quickly take you here that we've been doing decent volumes on this structure, and acceptability across European buyers, large and small, as well as the Asian side, has been very encouraging for us. The starting point here of the transaction is a platform which is completely seller focused. The buyer does not need to do any KYC or any onboarding on the platform, and that's where the point which Louis mentioned, that we are completely empowering the seller to come in independently, not as part of a larger anchor-led supply chain finance program. They can come in, they can submit their buyer details and ask for limits. KYC to the entire documentation piece that the platform handles is something which is done digitally, including reference checks from the existing lenders. Their past performance is taken care, and that's what brings in confidence on the other side to the European lending and underwriting piece, that yes, there is track record and trust that comes in when the supplier comes here. And from the seller perspective, it is very clear they are not concerned what is happening on the other side. They know they are selling to a buyer which is credit worthy in their local markets, and they just want to get paid. They want to do more business here and get paid as fast as possible, as easily as possible, with full digitization, and that's what the product brings. Eric, if you can just switch to the next slide, please. Yeah, so this is a live case study which I just wanted to share with everyone. So we have an SME manufacturer here based in India, which does recycled plastic bag manufacturing. We've been supporting them for over 2 years in terms of the cross-border financing piece. When they came in as our customer, the turnover that they did with this particular buyer, we have been successful together to multiply this turnover more than 3 times, because financing here was a challenge for them. The banks were not supporting it, but the buyer was 100 times larger than the supplier, extremely credit worthy, top rated in terms of their insurance rating. And the seller was initially only able to sell either on cash or maximum 30-day credit period when we started the solution. And now it has gone up to 60, 90 days of credit period, and the purchase order volumes have only been increasing year on year. Even during the pandemic, this business was intact. We haven't seen any pauses or slowdown which has happened across this business. So the right half of the slide, if you see the flow, as Thorsten had explained in his chart, is actually live in flesh and blood. What you see, that the exporter in Asia submits it to the Asian Trade Finance platform. The assignment and shipment documents and the invoice that they have raised on the European buyer, which is passed on as second assignment to the export factor, which is QuickPay platform in this case. And that is fully digital. There is no paper that flows here. The buyer acceptance, the most crucial piece. Once these documents are submitted, they are automatically shared with the buyer for acceptance. The buyer here is aware of the authenticated shipment documents, the status of the shipment, basis which acceptance flows in favor of QuickPay, which then releases the funds to the trade finance platform for us to fund to the exporter, the most crucial leg. While on this slide also it looks at a complex process, but we have been enabling to achieve this in a matter of couple of hours, right from the document cited to actually getting the funding going. It is done in less than couple of hours, and there are multiple transactions which happen through the day through this platform, and the volumes is what we are targeting to grow further. And then on due date, 60, 90 days, the buyer directly pays in and clears off the advance which the export factor had initiated, and the balance payment is then settled with the exporter, and that's how this solution is live and kicking.
Okay. Well, indeed, I think to be fast, that's fast. Having experience in cross-border factoring, I don't think you can get that done in less than 24 hours as you do here. But thank you for that. Well, this is great. This is also well on time and gives us the opportunity to get to next steps and to Q&A with our participants, with our audience. Well, I have maybe, I'm looking at the box, there's for the moment not any questions. So please send your questions. We would be very happy to take those. I have maybe one general remark for the panel. It's quite obvious that this whole project is not only Europe, Asia, it can perfectly also be USA, Asia, or other markets, Africa, of course. We have Louis on here. So this is really a global initiative. And we think, by the way, of course, of also organizing very soon a similar webinar, but then focused on the US market in terms of time zone. Second remark is also that we have our Vienna WOA conference coming up with hopefully one of the first real physical meetings, 4th and 5th of October in Vienna with the support of Raiffeisen Factobank. So I hope that we can also use that there as a good opportunity to rub shoulders and to listen to questions, to listen to ideas. Because this is now what the purpose of this webinar is. It's listening to your ideas and how can we take this further? Because you have seen that the project works, it's legally compliant, it's working from an operational perspective with a new NuFi system in place. we can perfectly now roll this out in a more broader sense. We could bring this into a sort of a distributed system for a World of Open Account platform. So what are your ideas? So I have a question here from somebody who says, hello, could you please provide some idea about applicable fees, charges for the involved parties apart from the interest charges? Who wants to take that? Is that something that Torsten or Pramit you can answer, or is this difficult to answer at this point in time?
I mean,
Torsten, go ahead, please.
Yes.
So maybe I take the European perspective, and then Pramit, you can maybe tell a little bit more towards the Indian perspective.
Mm-hmm.
So as I understood that correctly, it's about the fees and charges. So basically about the cost side. I mean, as always, this is, I mean, maybe this is the general answer on those questions. It's very much dependent on the situation. And talking about the European perspective, then I can tell you, of course, it's dependent on basically on the buyer's creditworthiness. So are we talking about a very good buyer? Are we talking about a buyer that is not that well known? How's the credit coverage for this buyer? So this is basically one major point, of course. And then secondly, it's also about the sizes of the invoices. So if we have bigger invoices per deal, then of course costs are down, and then we are also able to provide lower fees here. Talking about the interest rates, I mean, it's probably not a big secret. The European interest rates are very low at the moment. So we are on a yearly interest rate roughly between let's say 2% and 4%, also depending on the business. And then it's all about the fees. And maybe Pramit, you can also add a few words about that.
Sure. Thanks, Torsten. And perfectly. So it depends on the buyer seller, but I can give you the information that clearly the option that we offer to the seller here, it is lot more attractive compared to an unsecured financing without collateral that they would have available here. We are way more attractive than that. It is a no-brainer for them to decide in terms of pricing. Reason being, it's lot more expensive, almost to the tune of 1.5 or 2x to the options if they go outside of factoring that they get here. And in most cases, the situations that we come in and address is availability altogether, that they don't have that working capital availability, as we mentioned in the first slide. And that's what we come in and solve for, and solve extremely in a cost-effective manner. And at the same time, the risks are much better managed.
Yeah. Okay. No, thank you very much. And indeed, I think that's quite clear. And definitely the difference between the European interest rates and the interest rates in, that's one of the big advantages of this system, I guess. This is really one of the key advantages. But thank you for this question and also for the answers. I have a question from somebody in Africa working in a factoring company, found presentations interesting. Thank you for that. Our challenge with export factoring is usually getting buyers on board and ensuring an almost risk-free transaction. Do you have any advice on buyer onboarding and on these risks? I would like to, well, maybe it's one of the advantages of the system that the import factor will be implied in getting the buyer on board. But Torsten, maybe you can take this answer, take this question as well.
Yes, of course, Eric. Maybe I'll start with a general view, and then I'll hand over to Leah, who is more in the operational part. So in general, what we have seen so far is that there is a big interest on the European buyer side to really get the goods, so to make the import happening. Because we are talking about low prices or reasonable prices or very important supply in terms of goods that the European importers really need and would like to buy. So in general, let's say there's a big part in terms of the interest is on the deal itself. And also in this cross-border situation, the buyers usually have a very high interest to make the deal happen and also to support the seller in terms of financing. So so far we have not been we haven't really seen any major problems in onboarding the importers, but of course, and that is the let's say the more important part of it. It's all about communication towards the buyers. So you have to reach out to the buyers and explain them what's behind it. They need to know what's going on, and this is maybe the part where Leah can add a few words.
Yes, thank you, Torsten. I think I could add a few words from an operational perspective. I think what we a little bit missed out still is also the cultural perspective and the language perspective. I think also when we as a European factor are contacting European buyers, they really appreciate the geographical nearness and maybe also the legal background. We also had discussions about data protection and so on. And if they know that they can rely on European standards and European laws, I think they are a little bit more relieved. And yes, so this is also an aspect that we were confronted with. So I think this is also a big advantage of the system, that we have the cultural nearness, I would name it. And what is, of course, also important, that we as European factoring company, maybe we have better access to risk coverage within Europe and within the system. So this will help, of course, to onboard and to talk with the buyers as well.
May I also add something about this? The question is not always who are the buyers. I fully agree, by the way, what you just said is, but this is a seller-led proposition. So actually, if you are a factoring company in Africa, you should go to your SMEs and ask. They already have export. They want to export. I assume that. So they will, in a way, come up with the debtors. Then we go to Torsten and to the others to have the checks. That's I have an example even from Zimbabwe of canned products. The buyer is at that moment known. So the initiative, for finding the buyers should be also seller-led. So it's your local factoring company or a local factoring client that wants to export. Yeah. And of course, you can try to find buyers for them, but I think that the initiative should also come from your own client.
Absolutely. There's already an arrangement established, or a sale or a potential sale established. So you have all good reasons to contact the buyer that way, of course, that's clear. Time is almost finished. We have two questions which are a little bit legal. The first one, I'm not exactly sure if I understand it correctly. Is it possible to add the name of the factoring company on the buyer's sales contract against which supplier needs to import raw materials? I'm not sure if this is about the assignment or just to mention the factoring company. Well, I would say, we have Christian here, there's no problem to mention it's part of the assignment already from the beginning. Christian, you may want to add something to that question or to that remark.
Yes, Eric, thank you. I'm not sure if either if I understand it right, but to the questionnaire here, of course you can add the factoring company if your question is about if you may disclose the factoring relationship to the debtor on the beginning. Maybe that's the question.
Well,
yeah,
it's probably for next session to be because we really are running out of time. And there's one question.
Okay, but you may to give an answer if it may that the question. If you may disclose that, if you want to disclose that, you of course may disclose the factoring relationship. There's no problem behind it. You can do it still, and you can disclose it in our system here.
And stay with us, Christian, because this is a very interesting question, of course, also from India, to have more details regarding the assignment, particularly in India, noting that many sellers here have pledged their receivables already to their working capital funding bank. So the question is, can you assign a receivable if there's already a general pledge over receivables? Very traditional.
Yes. Technically, the platform which was introduced here today still works, but to be honest, under Indian law, you also can pledge a receivable only once. So if you do not own it anymore, it wouldn't be reliable to feed it into that system here, because actually we are dealing with a receivable which is owned by somebody else. So with your bank here. So please be honest here.
No, of course. No, yeah, sure. It's or then you have to rearrange your pledge agreements with your bank, maybe, to try and keep to have authorization to get this receivable out of their pledge. Yeah.
To keep it out of the security system with your bank. Yes, this applies actually to the relationship between you and your bank first here.
Good, but it's 11 o'clock, even 2 minutes late CST. I'm sorry for that, but good that we have so many questions. There's clearly interest. I would want to close this, or to wrap up maybe this webinar. I'm going to stop share so we see all the speakers and the panelists. I think it was interesting. I would like to see if there's any last comment from the panelists. Torsten, you would like to add something? You're muted, so I'm looking at you, but if you have some famous final words.
I think I've said already everything, basically. So no, thank you for the opportunity, and thank you for this platform. And of course, we are very much looking forward to your comments and questions. Also, after this webinar, feel free to reach out to us and ask your questions. And yeah, we are also very curious how we can develop this platform in the future.
Okay, thank you, Torsten. Leah, I suppose you agree with Torsten, or if you have anything to add, please do. Louis, any comments from your side? You are muted as well, so please unmute yourself before you say something. No.
Yeah. No, I have no. Let's get going. I think it's a very good initiative.
Okay, good. And Pramit, what do you want to add?
No, and nothing from my side. Thank you so much. And as we said, let's get going. A lot more work to do. Okay,
thank you. And Christian, anything to add besides the fact that everything works well legally?
Nothing legally, but I can tell you that this is a great achievement, which was reached here. You do know a lot of approaches in international factoring. They are all very complex, all very conflicted by different laws, and so on and so on. Mm-hmm. And what was done here is, I think, quite innovative, because it eases up international collaboration a lot, and on a legal perspective, I can tell that. Yes. All right. Thank you very much. And Frank from China.
Yeah, thanks. Yeah, thank you very much. And I think this is a very, very good start, especially for the innovative structure. And I do look forward to have a deeper communication with everybody, and look forward to the webinar next time, if possible. Thank you very much. All right, thank you. So I would like to thank you all panelists, and of course also the people who have attended this meeting. Please reach out to us if you have questions or suggestions.
It is about collaboration. There's nothing special about it. We do not try to sell to you anything here today, quite on the contrary. It's really about trying to build together something that can be profitable for all, a new way of doing business cross-border. And it has, as I said at the beginning, there is already meat on the bone, and that's something which is important. It's not just a wild idea, so we could move fast if you want, but it's all up to the community now to pick this up, and we will be very happy to help you running with that ball in the future. So thank you all.
And Eric, if I may add that, I think we all are open to discuss that further in Vienna at the annual meeting of World of Open Accounts. So you all are invited to come, and I think we do have time to discuss and to dig a little deeper in all the legal and commercial parts of that system here, if you are interested. Yes.
Very good point. Thank you for that, Christian. Indeed, we hope, of course, that all travel bans will, in the coming weeks, be completely finished, and we get back to some form of normal, and with a new physical meeting, one of the first ones, I guess. But indeed, it would be good to have a real meeting to discuss this in more detail.
Just one point, Eric, as Christian said, right, in terms of scalability and easiness, this is, I think, one of the only, discussions that I've had where we have spoken about trade finance and we don't need blockchain to actually go ahead and start funding it.
Well, never say never. Who knows? Maybe we'll, let's not do that. Let's not waste our time with that. All right. Thank you very much all. Enjoy the weekend. Stay safe and enjoy your holidays, and talk to you soon. Bye-bye.
Thank you.
Bye.
Goodbye.